Failing to increase the debt limit would have absolutely catastrophic economic consequences. It would precipitate a financial crisis. It would threaten the jobs and savings of Americans, and at a time when we're still recovering from the COVID pandemic. Well, she's right. It is unthinkable because it's never happened before. The US has never defaulted on its debt ever in its history. That's why treasuries are rated AAA. It would be unthinkable. So could the unthinkable be possible this time?
Well, it's definitely possible each time. It's just one of those things that, pretty much by definition, it's a very, very low probability event. And if it were to occur, it would probably occur briefly and then be rectified. However, for example, some of the things that happened in say the capital of the U.S. earlier this year were previously thought unthinkable, and they still happen. So, investors have to watch out for these kind of tail risks that can happen. But in general, since the debt ceiling was implemented in the early 20th century, it's been raised something like 100 times, and so by both parties, and it's just it's historically been mostly a non-politicized event, but in certain periods of time it starts to be used as a tool, and so the way the debt ceiling works is you're not raising the debt ceiling for new debt. You're raising it to basically pay existing obligations that they've already signed into law, right? So it's not about new spending. It's about maintaining ongoing spending that they've already allocated. So it's different than, say, a fiscal stimulus bill or something like that. And so in some ways, it's philosophically counterintuitive to fight over the debt ceiling because, they already obligated that spending. But on the other hand, they use it as a practical tool to try to get something, from the administration when, because it's basically a strong bargaining chip. It's kind of like playing chicken.
Why even bother having a debt ceiling then?
Well, so originally, they had to approve every increase in the debt. But when the government became above a certain size, that became untenable. And so instead, they started to batch it together, and they said, okay, instead of approving every single one, we're going to we're going to allow a certain amount of additional debt to be issued by the Treasury. And so they would just kind of raise that every, period of time when that was reached. So it's basically a way that Congress can still have some degree of control over debt issuance, but simplify the process. And so, 9 times out of 10, it's not really a political event. But every kind of 10th time or so, that's when they can use it for more political gain.
Okay, so suppose they don't raise the limit. Let's just suppose that happens. What would be the immediate consequence? It means, of course, the Treasury can't borrow more funds to cover their existing debt obligations, which means they would have to default on some of their existing payment obligations, right?
Well, so they have a couple levers to pull at first. So they still have a cash at their account with the Fed. So the Treasury General account, they can draw that down. They also, they've been in this situation before where the debt ceiling was not raised, and they basically have some weeks or some months of juggling books around. They call it extraordinary measures to try to basically avoid some of the more tangible effects. And so they can do things like draw from the G fund of the federal retirement system that consists of treasuries, kind of unique treasuries. They can, basically they can eventually do a government shutdown where they reduce payments that are going out to different things. And that, that gets paid back afterward, at least part of it. The federal salaries get paid back, the contractors generally not. But basically they have a couple levers they can start pulling before they get to more serious things like Social Security checks not going out or Treasury coupon payments failing to deliver.
Yeah, that's never happened before, either of those things, right?
They've not gotten to that point. I think that there decades past, there was some minor technical issue where a couple coupon payments were delayed, but those were not due to a debt ceiling issue. It was kind of a technical issue. So it's never really happened from a debt ceiling problem.
Can we talk about the politics behind deciding on raising the debt ceiling? What's with the gridlock right now? What are they negotiating that's taking so long?
Well, naturally, it's just a way to get different kind of brinksmanship. And so, for example, there's this ongoing infrastructure bill they're debating over, and it's as kind of public market participants, we don't necessarily know what they're talking about behind the scenes and what kind of deals that they're making. And so there could be any sort of things. It's also a way to kind of signal to your constituents that you're aware of the debt issue and that you're basically doing your part to push back on it. So, like most things in politics, there's kind of a theatrical aspect to it, but it is something to monitor. And so even if the debt ceiling, doesn't cause that kind of tail risk catastrophic outcome, it can still have certain implications. Like, for example, during that period where the Treasury can't really issue new treasuries, that can potentially issue rates. And ironically, it could be what's partially contributing to rates going down at the current time, even though it, in theory, it increases default risk, because it basically kind of threatens the supply of treasuries over the next kind of handful of months. And so when you have excess cash in the system, you have needs for collateral among financial institutions, and so that could ironically be pushing yields down to some extent.
Recall in December of 2018, Trump shut down the federal government over disagreements on how to fund the budget for the following year. Speaking of theatrics, could that happen again? Because that would be really bad. It means a lot of government workers wouldn't receive paychecks during the pandemic.
Yeah, it's certainly possible. It happened under Trump. It happened under Obama. And it happened before then, but it's been more frequent in the past decade or so. And so basically, if that happens, there's certain kind of things in place where the federal workers would get paid back after that's over. That used to be in doubt, but now that's more kind of written in stone. However, the U.S. government also employs a large number of contractors, and they generally don't get that back pay, and so that basically would impact some of the spending patterns of people. Now, they can do things like go on temporary unemployment and things like that. But basically, that would be a pretty, notable but still mild economic disruption at a time when, in some ways, the economic growth variables are already kind of decelerating to some extent from their peak highs.
Okay, so Lyn, we know that the U.S. could technically raise the debt limit, but the problem is whether or not they could actually afford to raise the debt ceiling. This question has been posed to Jerome Powell before, whether or not we can afford it. At $30 trillion of gross national debt, we have the highest debt on record so far. This has been asked to Powell before, the issue of the interest rate rising to the historic level of 5.7%. At 5%, not even 5.7, but at 5%, we're looking at $1.5 trillion of annual interest expenses on $30 trillion of debt, assuming, of course, by that point, debt is still at $30 trillion. So could we afford that $1.5 trillion? And we have $3.5 trillion of tax revenues every year. So about half our tax revenues would go to interest expenses. Is that math right?
For the early part of the question. So again, the debt ceiling is about funding that's already been allocated. And so the kind of the real question has to be directed to, can we afford further stimulus? Can we afford these kind of structural budget deficits that we have? And so those are kind of two separate debates, because one is about kind of fixing forward spending patterns, and the other one is about paying for previously allocated funding patterns. But going to the bulk of the question, the short answer is no. Basically, at $30 trillion in debt, 5% interest rates, as you pointed out, that would be $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. Now, there's a couple nuances there, because that refers to the average of debt outstanding. And so that would include, from the federal government, that would include short-term like T-bills, as well as that longer-term debt. And so that would depend on basically some of those long-term low interest rates have already been locked in. But there is a very, very large percentage of the treasuries that actually consists of short-term T-bills. Last I checked, well over 10 trillion was that very short-term number. And so that basically is tied to the Federal Reserve's interest rate policy. And so the short answer is my base case for a couple of years now is that, this looks a lot like the 1940s in the sense that that's the last time that U.S. debt to GDP was as high as it is now. And basically what they had to do back then was lock interest rates at a very, very low level, even when you had these bursts of inflation. And that's because they found themselves basically fiscally in a problematic space. And so the downside there is that if you're holding cash or holding bonds, you can fail to recoup your purchasing power during that period. And so that's actually one of the big differences with the 70s and the 40s, is that the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, despite inflation, pretty much whatever you do, they couldn't raise interest rates. And so that's generally a pretty good case for holding real assets at this current time, because I think we're still on a path towards currency devaluation. And it could happen in bursts, or it can happen just over the course of a decade of having interest rates that are below the inflation rate.
Okay, so let's first talk about the tools they have to control this problem. You mentioned locking in interest rates as one of them. What does that mean exactly? How can the government lock in interest rates?
Well, for example, if the government issues a 30-year bond at, say, 2.5%, then it, even if interest rates go back up, that bond, they still have a fixed contract of coupons to pay, at that initial rate. And
Okay.
so basically the extent they lock in that longer term yield, they basically buffer themselves against rates going up. However, in recent period of time, they've actually been kind of decreasing their average maturity. They've been issuing a lot of T-bills. And so a very big chunk of that debt is susceptible to an increase
Right.
in interest rates if the Fed were to do that.
Okay, so most of their debt is relying on variable interest rates, is what you're saying.
A good chunk of it, yes. I mean, they have that full spectrum from very, very short all the way up to 30 years, and a very big percentage of it is under 5 years.
Okay. Now, what about the possibility of interest expenses reaching? Is there a number in your mind, Lyn, where interest expenses become unsustainable, unaffordable? What's that number for you?
Well, once you would see kind of average treasuries getting up to maybe 3% or so, that'd become pretty fiscally kind of impossible. And I would actually already say at that point, at where we are now with both the United States and as well as some other developed countries, debt as a percentage of GDP pretty much almost mathematically can't be kind of serviced in real terms. Meaning that we're in an environment where most paths kind of point towards currency devaluation, and
Mhm.
so that could take the form of, say, interest rates being 3% while inflation is 6%, or it could take the form of interest rates being 1% while inflation is 3 or 4%. And so there's a couple different kind of ways that could look like, but they all involve pretty much having these persistent periods of negative real yields, which is, again,
Okay.
that's a problem for pensioners, challenging environment for banks, and just challenging for any saver or bondholder.
All right. So currency devaluation is one consequence of the path forward.